The car market might give us some clue onto what's going to go on in the real estate market. Let me explain. While a car is not the same thing as a home, an automobile is considered a depreciating asset, whereas real estate is considered more of an investment where over time it does appreciate. But there is a new car market and a used car market, just like there is a home for sale that somebody's lived in versus a brand new home in a development. So let's talk about what happened with automobiles and how it related to the real estate industry. If we look back to about 2007, when the real estate market was starting to crash, people were getting foreclosed on and banks were taking back homes and wholesaling them out on the public market. That was back when you could drive down a street and see 3 or 4 homes for sale with dead lawns. While interest rates were not 3%, they were usually in the high 6s to mid 7s. The price of the homes had come down substantially. In fact, you could very easily purchase a home that would have been $500,000 just 2 years before. You could likely pick up that home now for $239,000. So even though the interest rates by today's standards, well, were about even, but not anywhere near like they were when we were getting 3.5 or 3.9% interest rates, it was an affordable option because of the purchase price of the home. At the same time, the automotive industry was offering lots and lots of incentives in order to be able to move new cars. So they could buy your used car and they could put you in a brand new car at a very reasonable price, but also be able to give you a very low and sometimes 0% interest rate spread out over sometimes 7 years. In doing so, it made the affordability of buying a new car pretty easy, and people did. The new and used car market was fairly balanced. When you bought a used car, your interest rate wouldn't be as favorable as a new car overall, but the price would be lower because the car already had existed for several years and had a little bit of wear and tear. As usual, we all know the adage that, your car starts losing value the second you drive the new one off the lot. So if we fast forward to 2018, when we started seeing shifting in the markets, both in cars and in real estate, we started to see that the price of new vehicles had actually gone up substantially. Then as we hit the COVID era, we saw supply dwindle. If you remember driving by like maybe big Ford or Chevy lots, there were hardly any cars or trucks available for sale. Interest rates were low, but there was no inventory. In fact, if you walked on a Ford lot and asked to buy an F-150 with a certain package, you might be waiting 6 months before you take delivery. The automotive industry looked at this and said, well, fine, we can charge a premium. For years, anytime you bought a new car, if the sticker price was $50,000, the dealer already had a gigantuan markup on the window sticker, and that is just what you had to pay if you wanted to get into a new car. That started moving people into the used car market. But because there were not enough people buying new cars anymore, there weren't enough people selling cars, so there weren't used cars on the market. Therefore, inventory of both new and used declined. In order to make up this difference, people started overpaying for used cars. In fact, you've probably experienced or heard stories from people you know about somebody that maybe had a 4 or 5 year old Toyota pickup truck that was able to get what they paid for it when it was 5 years old. This drove up rapidly the used car market, and that was what everybody was fawning for. If you had purchased a car at a dealer and had it for a year, your email inbox was blowing up with offers of, we want to buy your car, we want to buy your car, we want to buy your car. Because the dealer shifted focus off of selling new cars into the used car market. So we started to see the same thing in the housing market at the same time as we entered COVID. Because there were so few people putting their home on the market and making a move because they had refinanced into the artificially low interest rates, they couldn't fathom selling the house and buying another one because prices had gone up so much. And while they might have had a ton of equity, they didn't see the point in trading house A they were already in and had a great payment on to get house B, which would cost them a lot more even if they put all the equity from house A into it as a down payment, even though the interest rate at that time still would have been good. So what happens? The new home market blows up. Real estate agents that were taking buyers out to look in a neighborhood and looking for sale signs in people's yards started shifting their focus into new home developments, sometimes going far, far, far out from the target area that buyer wanted to live. So now new home prices exploded. Then we get into rising interest rates. As the interest rates rose, we started to see affordability drop even more substantially than it already had due to the price increases of real estate. The same thing continued to happen in the car market. We started to see a better balanced inventory of new and used, except the used cars were priced like they were new, and the new cars were still priced over what the manufacturer suggested retail price was, or the sticker price. And the interest rates were higher. So now that truck that you could have bought a couple years ago for $50,000 was now $75,000, and instead of getting a 0 or 1% interest rate, you were looking at 6 or 7%. The payments went from an average of like $720 a month for that truck to $1,100 a month. At the same time, car insurance went up. In fact, in California, most people without tickets or accidents, the cost of their insurance has doubled. The same thing happened in the real estate market. We started to see resale homes, homes that had been lived in that were being sold by the seller, actually outpace the new homes for pricing. Eventually, this started to run a baseline standard as the availability of new developments and new homes lessened. Add to that a lot of the new developments in some of the areas of Southern California are rental-only communities where the homes being built will always and forever be a rental community that's owned by a corporation, thus limiting the supply available to a buyer who wants to actually own the real estate they live in. So now we have high interest rates, high insurance costs for hazard insurance on the property, and an interest rate that's not favorable that makes the monthly payment very, very, very difficult. So what are we going to see? I don't know. There is some prediction that the forces that be are going to end up forcing the price of homes down, but we don't know how long that's going to take because there is still such a shortage of inventory on the market. But if we look at what the car market is doing right now, even though the interest rates on used cars are still particularly high, on new cars, the manufacturers are subsidizing those interest rates. In other words, if you walked on the lot and you got your own financing, let's say from your bank, to purchase a new vehicle, you might be paying 7%. But the car dealership, being able to put their own money into buying down and subsidizing the rate, is able to offer you maybe half that, maybe 3 to 4% interest rate if you buy their new car. This is the same thing new home builders are doing. You will find that they are offering lower interest rates than you can get on your own simply because they are subsidizing it in order to move the property, because otherwise these homes that they have built may sit too long because of affordability issues. That hasn't happened in the resale market yet. But if we go back to the new cars, if you walk on a lot, you will now see 2 model years worth of inventory on almost every make and model that car manufacturer makes. They are stacking inventory and they can't move it fast enough. So they are not only subsidizing the interest rates, but they are now slashing prices. This also affects the used car market because now cars that, let's say, big dealerships like Carvana, etc., where they go out and their entire business model is purchasing used cars, may have overpaid for the cars that they have on their lot and in their inventory. They're having to take losses in order to move that inventory. We saw the same thing happen with the rental car companies that had invested highly in all-electric vehicles, starting to liquidate their entire fleet of those kind of vehicles because they're not cost effective. because people aren't renting them. So therefore, they're selling them at a loss. Well, if we're seeing the new cars being sold at a loss and the only thing keeping the dealerships afloat are subsidies from the car manufacturer, I wonder what the long-term ramifications of this are going to be in the car industry. And can we paint that same picture on top of what's going on in the real estate market? Only time will tell.